Last year, we recorded a show which dealt with the basic principles of international property investing. Please visit our blog page for all the details. And this year, we're taking a look at the factors driving global property prices in some of the major business hubs across the globe. Gentlemen, welcome to the program. Thank you so much for joining us. Kobie, as I mentioned, we had a show last year. We focused on the basics and looking at the crux of the matter. Now we're sitting in 2012. Things are looking slightly better. Just yesterday, we actually saw the new home sales numbers released for the month of January in the US, up 1.5%. Yep. Things looking slightly better. Yeah. Is this your prognosis as well as we kick off the year?
But I mean, and I think the big thing is that you've seen sentiment shift, you know, since kind of late last year, and maybe, you know, that with a backup of some economic numbers that are coming through, kind of showing that things are slightly improving, is obviously shifting people's kind of appetite for risk-based asset classes at the end of the day. And you're quite right. You've seen those home numbers starting to look slightly better, and they're the recipient predominantly of commercial and kind of industrial space. And you know, once those kind of spaces start doing well, then residential start doing well on the back end of that. And that's certainly been the case in the US. Not necessarily been the case as we look at Europe and Asia's maybe got some other issues, you know, kind of at play. And that's why we've decided tonight to do a show on global property. So many South African investors own global property, and they've got some stakes in businesses on a global space, in a global sense. Many South Africans own property, specifically in the UK. And with that set in mind, what we want to do tonight is we want to take a whirlwind tour. We want to go and have a look at property in the US, property in Europe, and then end off with property in Asia, and actually have a look at how property has actually performed and some of the challenges that potentially are in that space in 2012. So with that set in mind, let's maybe start off by having a look at your screen, and you'll see a chart detailing some property, and this is about specifically apartment completions in the US, and you can see that the amount of supply that's coming online is actually dwindling. There you see 2009, 2010, and 2011, and it's the same trend. If you see office completions, you see those dwindling. And if you have a look at retail completions, you see those are dwindling as well. And that's just back on this financial crisis that we've seen. And the financial crisis, obviously, as that plays out, you just don't have that much property coming online. Here's industrial completions. And you can see those also exactly the same type of trend. Yeah. That obviously influences what happens in the property space. Maybe a question for you, Jamie, just off the start end. What difference does supply and this kind of drawdown or drawback in supply make, and what effect does it have on demand for property specifically in the US?
Thanks, Kobie. Yeah, look, supply is obviously a major factor driving market rental prices for commercial property. Obviously, with very little supply on, vacancy slowly gets mopped up, and as that vacancy gets mopped up, tenants' choice becomes less. There's less available supply because no one's bringing on new supply, and at that point, landlords start to get the upper hand over tenants on what they can demand for rentals, literally because they don't have any other option. So supply is a huge factor in determining the fundamentals of where the state of things are in a property market in specific regions. And I think pervasive across the whole globe at the moment is that there is very little supply that has come on over the last few years, and there is very little supply going forward.
Well, Jamie, the truth is that we had overcapacity, we had oversupply in the US, and this is what actually created some of the problem in 2008 when we actually saw the credit crisis, which we know was actually spurred fundamentally by the housing market. And now when we start to see the scenario changing and demand slightly starting to increase and supply slowing, isn't it now creating a more balanced environment than what we saw pre-crisis?
Yeah, definitely. I think just the one thing to differentiate, I mean, what we are talking about is commercial real estate. So we're generally talking about offices, retail, so malls, shopping centers, high street retail, industrial. There is some residential in there. There are, specifically in the US, there are large owners of apartment blocks, but they own to rent out. We're not talking about the housing market where the individual on the street owns a house in the US. But you're right, supply did get ahead of itself. Obviously, as market rents are booming, there's availability to construction finance, everyone starts developing. And then with the crisis in 08, market rentals came off, viabilities to develop just were not there anymore. So anyone who could stopped any development that they were doing. And as a result, you're slowly starting to see markets mop up that additional supply that had been brought to market sort of pre-08. As that supply gets mopped up, it becomes so at the moment, tenants still definitely have the upper hand over landlords, but as that supply gets mopped up and vacancies start to decrease, landlords will start to come into parity with tenants and start to be able to push rents in certain markets.
I mean, by the way, Eleni, I mean, that's why you see construction as a side, stonewall. That's why it's such a cyclical play, because construction literally stonewalls when the property cycle does something like this. And that is kind of important from a portfolio construction perspective, especially if you're going to be thinking of owning construction businesses. Jamie, maybe just a question quickly from my side. What is global, I mean, American property at the moment, what are the yields that you're seeing coming through for some of the big listed entities? I'm obviously talking about companies that are well capitalized and so on. What are some of the yields that you're seeing for the sector?
Yeah, I mean, look, when I talk about yields, I'm going to talk about funds available for distribution. Companies don't necessarily pay out 100% of earnings, so I'm not going to talk about the divi yield. I'm going to talk about what they could pay out if they paid out 100% of funds available to distribute. And there you're generally looking at about 4.5% at the moment. The range varies, but sort of from 3.5 to sort of 6.5 for companies that maybe are in weaker markets or have weaker balance sheets, etc., etc.
Jamie, also just looking at the health of the overall economy in the US, we have to look at it from a macroeconomic perspective, looking at the growth scenarios that are expected to increase this year, far better than what we saw in 2011. This is also going to have quite a big impact when you talk about the supply and demand scenario and the opening up of new malls and commercial property and even the use of industrial space into 2012. Are you convinced that the US market is healthy right now, that the bottom is behind us and now is the time to start investing within this space?
Look, I think the data that's come out over the last few weeks has definitely been encouraging. I don't think we're 100% out the woods. You know, Europe is obviously still a huge overhang on the world economy, but you're starting to see signs of some recovery. I still think across all markets and in the US as well, you know, your quality real estate is still going to outperform over the next couple of years. I mean, you just have to look at mall sales. Macerich, Simon Property Group, they came out with results recently. You know, tenant turnover in those stores was 11 to 13%. Now, if your tenants can increase their turnover by 11 to 13%, down the line, that gives you the ability to increase your rentals in line with that. So, while tenant sales across the whole of the US weren't in the teens, strong malls and good quality properties are able to capture actually some of that spend from other centres that are a bit weaker. And yeah, I mean, I think there's going to be a huge differentiation between prime and secondary properties. It's already happened over the last 2-3 years.
Yeah.
Going to continue to widen over the next couple of years.
Right, we've now spoken on the US. Let's now delve into the European market.
Yeah.
Europe is in a far worse position, obviously, than the US from a debt perspective, and depending on which zones you're actually looking at. So give us an overview.
When you're looking at Europe as a destination for listed property, obviously you've got kind of the fringe, the mid countries, which obviously is sitting with a whole bunch of sovereign issues that you need to take into consideration. What we're going to do this evening, though, is we're going to try and focus more on kind of the larger property companies that are kind of focused more on the kind of bigger Eurozone type countries. Have a look at your screen over there, and you'll see an example of a business such as that. This business is called Unibail Rodamco, and you can have a look at their specific tenants. They're obviously a property company, and these are their tenants that lease space specifically from them. And if you have a look at since to the year November 2011, you can look at total tenant sales for Unibail Rodamco is up by 2.8% for the year, relative national sales, which are basically tenants leasing space from other property companies, which is down minus 0.8%. And as a matter of fact, let's look at exactly the same chart, but now let's have a look at Unibail Rodamco, tenant sales in France, relative to some of their competitors. There's Procos, CNCC, and IFLS. I mean, Jamie, this is clearly a stock picker's heaven. I mean, you know, you're sitting in a situation where some guys are producing and some guys aren't producing, and that obviously gives you the ability to go and shop for yield as a fund manager.
Yeah, I mean, just looking specifically at Unibail Rodamco, I mean, it's about as blue chip as you get in Europe. You know, they're in the top quality centres and capital cities across Europe. And they do have exposure to Spain, and they do have some exposure to some of those peripheral countries. Their core market is France, but they pan-European exposure. But actually interesting to note, some of their centres in Spain are actually trading very well. So it just goes to show that even in a weak macro environment, a good centre in a good location, a good catchment area with good spend being driven through that centre can still capture good growth. I mean, if you just look at where tenants want to be, tenants at the moment, especially retailers, they're rationalising their stores, they're chopping stores, they're going from 500 to 400 stores, and the 100 stores that they're not in, they can capture that spend through online trade, spending or whatever the case may be. But those 400 stores that they've still got, they want them to be in the most productive space possible. So they want to be in the centres, driving the most foot traffic, driving spend in those centres, and ultimately that space to be as efficient as possible for them. And I mean, Unibail Rodamco, you compare them to their closest peers, Klépierre and Corio, who they came out with tenant sales growth of -0.8 and -0.7 in line with averages. They own portfolios in similar regions, but Unibail Rodamco is able to capture plus 2.8% tenant turnover. So it just shows you can be in the same markets, but if you're in the wrong centres, you can get very different
So what
results.
is the yield then in Europe, Jamie? What yields are we looking at there?
Europe, you're looking on average at around 6.5% FAD yield, and it really does. There's a wider range in Europe because there's obviously more specific risks involved, both from a balance sheet point of view and a regional specific point of view.
Jamie, maybe just a quick question, just from my side. We've looked at Europe, but we haven't yet quite dealt with the UK. Lots of South Africans obviously own property in the UK. Sure. Yields on the commercial space, on a commercial space basis there, what do yields look like in the UK? Similar to Europe? Yeah,
they're probably slightly below Europe. So your heavyweights, land securities and British land, FAD yields of 5.5 to 6.5%. They're obviously the two large caps in that market. We actually, although pricing doesn't always give us the ability to buy the other stocks, we prefer the specialists in London. So you've got names like Derwent London, Great Portland, Shaftesbury, who are very focused in what they do. So Shaftesbury owns a retail portfolio, and you can literally walk around their assets in half a day. Just West End, it's restaurants, retail, apartments in that market. And their specialisation, just knowing those areas, knowing the landlords, knowing when deals are coming up, just give them that ability to just outperform in the long term. Unfortunately, yields on stocks like that are sub 3. So you're getting a lot of growth, but pricing is quite expensive on those type of names. But in those large caps, you're getting reasonable yield. You're getting 5.5 to 6.5% FAD yield. Your divvy yields probably 4.5 to 5.5, and in the 10-year government bond in the UK just over 2. So, and you're getting a little bit of growth on that. Not much, but a little bit of growth.
So could we give us your?
It's reasonably attractive.
Okay, so could we give us your view quickly on Europe, because we have to move to Asia?
Okay, let's quickly do an asset allocation huddle here.
Yeah.
Okay, if you have a look at global property at the moment, yields are sitting up at like 4.5%, 5%. You can buy companies on a global basis for similar yields, and I'm talking about divvy yields here, with cash rates running down at 0.5%.
Yeah.
Certainly from an asset allocation perspective, you certainly want to be looking at some of these.
So Asia is quite exciting, especially when you look at the Chinese scenario, because we keep saying that there's a property bubble there, but others say that actually there is no property bubble because it's real demand, not only in the residential space, we're talking across the board here when it comes to property.
Absolutely, and if you have a look at your screen over there, you'll see a map of Hong Kong. And as a matter of fact, if you want to be in Asia, Hong Kong is still the gateway to China and still provides you as an investor through the Hang Seng with liquidity that you won't have anywhere else. You're looking at the island of Hong Kong, and there's two big property companies that are in this space. The one is called Hong Kong Land, and you can see it at the top end of your screen, and the other one is Hai San. Hong Kong Land has got a huge amount of property that they own around the central area, and if you've been to Hong Kong, you would have gone down to the financial district. That specifically is what we call the central area. A little bit down from there is an area called Wan Chai. And Wan Chai is certainly an area that is busy developing, and that's where Hai San owns a lot of their property. Jamie, are these two of are you looking at these to buy into your fund specifically?
Yeah, the Hong Kong Land we've held for a while now. The Hong Kong office market was particularly weak last year. Hong Kong is quite sentiment driven, it's quite cyclical, and with the crisis in Europe, it was probably more affected than say the US was. And a company like Highsand came under a lot of pressure, and we took the opportunity to upweight, or actually to buy Highsand and go overweight there. Those two names we sort of started buying quite heavily towards the middle and third quarter of last year. Hurt us a bit last year, but have had really good years this year. They're up 20 to 30% this year, those two names. Just fundamentally, we think that the Hong Kong office market sentiment downturn was completely overdone. It's a market with, of all the markets, office markets across the world, demand is still reasonable. I wouldn't say it's strong, but there is some demand, and there's really no supply going forward. I mean, Central's got about 5.3% of existing stock coming on over the next 3 years, so that's in total, not per year. And Wang Chai, Causeway Bay has got even less than that. So, in markets where demand is sort of 3 to 4% per annum growth. So if you're in that market as an existing landlord, the lack of supply and lack of other opportunity just is a great underpin to us for owning real estate assets there. Hong Kong land last year, you could pick it up at a 6.5–7% forward fair deal. Yeah. It's come off a little bit because it's run quite nicely now, but we still see it as reasonably attractive in a strong market.